Welcome to Blue Margin's Expert Insight Series. My name is John Thompson. This series is for the benefit of private equity partners and mid-market executives who are looking to use data to accelerate their growth and profitability in business. Today, I have the pleasure of welcoming John Parent. John is an investment professional at Industrial Growth Partners. He's been with them for 7 years. And he serves as a director or has served on companies APCT, Redco Group, Royal Power Solutions, and SPL. IGP has specialized in the industrial sector for the past 25 years, focusing on engineered products and industrial services. They currently have $3.2 billion under management and just closed on their 6th fund, and they've invested in over 40 platform companies to date. Their mission is straightforward: to invest in and build global market-leading industrial companies. At IGP, John is responsible for sourcing and evaluating new investments and to partner with portfolio company management teams to drive the value creation plan. Prior to joining IGP, John worked in the industrials group of Robert W. Baird & Company as an investment banking analyst. It's great to have you here today, John. Thanks so much for joining us.
Yeah, thanks a lot, John. Excited to chat with you.
Yeah, pleasure. So, John, every PE firm, and we've worked with quite a few, has different aspects that they focus on in executing on their investment thesis and successfully helping portco companies to grow. Things like digital transformation, financial engineering, operational excellence, multiples arbitrage, if you will. What elements does IGP focus on? In other words, what makes your firm unique compared to others?
Yeah, it's a great question, John. And just a little bit of background, and you mentioned it in the preamble, but we've been around for 25 years, and we've been focusing on the industrial sector for our entire existence. So we've only invested in manufacturing and industrial services companies. And so when you think of 2.5 decades of experiences, and successes and failures and challenges, and just that duration of investing in one portion of the economy, we think it ultimately creates a pretty unique set of experiences, a network of advisors and relationships that we hopefully can bring those experiences and those resources and tools to our portfolio companies to give them more than just capital, to give them additional insights, additional experience that they can leverage as they're trying to build their companies and execute on their strategic plans. As it relates to value creation, your specific question, we don't have a specific formula. We don't go into companies saying, we're going to use the same 5-point plan for every opportunity. On the contrary, we look at each company uniquely and look at their specific plan and their specific opportunities and try to work with the management team to ultimately execute on the biggest opportunities and mitigate their largest risks. So that could be, very different across the portfolio, but it is, again, kind of bringing that toolkit, bringing that experience set, and then figuring out for that specific company and their specific opportunities how best to move forward through the partnership.
Yeah, that makes sense. Each company is so different. If you had a rigid formula and framework, you'd sort of be stuck in mud. At the same time, there's a lot of generalists out there, and yet a trend in PE towards specialization. And obviously, you guys have a specialization. I'm curious if you see that trend continuing, if you're evolving into either even greater specialization, or how's that trending?
Yeah, we'd like to say on this point in the private equity universe, we've probably been a little bit ahead of the game, that it is a hot topic in private equity, right? Specialization firms, you need a narrower focus because it is, at least our belief, it is harder to create alpha, outsized returns if you're investing in software one day, industrials the next, consumer retail. Now, you may have really successful generalist private equity firms that have their verticals within and then their specific industrials team. But as it relates to that specialization, we only see that continue to continue going forward. And even within IGP, there's certain areas we want to dig even deeper than maybe historically we have in the past.
Yeah, great. Okay, that makes sense. Probably more than any other industry, manufacturing is subject to a lot of the impacts that are happening right now around supply chain disruption, commodity pricing volatility, increasing operating costs. How does IGP mitigate those forces that are largely outside of our control? What are you guys doing in these headwinds right now?
Yeah, absolutely. I think there's a couple of things. One, we're always looking at publicly available data, whether that's Fed industrial data or Federal Reserve information, as well as leveraging information across our portfolio. So when you think of, we're typically looking at or invested in, call it 10 to 12 companies at any one time. We are aggregating information from those companies, whether it's input costs, bookings trends, et cetera, and trying to figure out, are there trends that should be incorporating into our underwriting or incorporating into our management of our existing portfolio, whether we're looking at a specific end market, a specific geography. But you start to aggregate all those data points and look at them on a as real time basis as you can. It's probably more like weekly or monthly, but ultimately that helps you, give you insight as to kind of where we're going rather than where we've been, and use that to assist our companies and our management teams as best as possible.
Yeah, good argument for specialization. How significant is that internal benchmarking for driving progress? Is that a major piece of what makes you guys move forward and be successful?
It is. It is in the sense that it is a one metric, right? And you still have to look at each company specifically, right? When we're looking at our wellhead and pressure control solutions business in Canada, Redco, they have very different demand drivers than maybe our AEM, our fuse component manufacturer in San Diego, that's serving more aerospace and defense and electronics end market. So there is relevant data that can be gleaned from a portfolio-wide analysis, but also needs to be looked at with nuance and understanding each specific investment and what they're facing.
Sure. Yeah, that makes sense. So what tools does IGP use for forecasting and scenario planning and those sorts of things that is increasingly important with some of the unknowns about where we're going in the economy?
Yeah, that's a good question, John. I mean, again, we're looking at kind of portfolio wide. We're getting the the information from our companies in terms of at least from a demand perspective, trying to break that down by end market, by geography. Each specific company will also have in their CRM. We're always pushing our companies to get more and more customer feedback, not just did you win the RFQ or did you lose the RFQ, but start to pick up and aggregate on those trends. And then from there, you can build out not only your demand forecast, but ultimately, your cost structure, your capital investment requirements, your capacity planning. It really kind of feeds into a lot of different, components of managing those businesses on a day-to-day basis. But I wouldn't say we have kind of any magic tools that any other private equity firm has.
Yeah. It makes me think of a lot of conversations I've had with PE firms of recent where they're looking for a standardized, normalized, more efficient way to look at the metrics that are common across portfolio companies, no matter what industry they're in, particularly around that gap. How much do we have in backlog? What does our funnel look like? What are our goals? How does that compare to last year? And what's the gap? And how are we planning? Are you successful at getting that sort of high level critical view into how your revenue for a particular portco is looking in the coming quarter or 2 quarters? Do you get that across the portfolio pretty successfully? And how do you do that? Do you just get a monthly spreadsheet? Do you have a methodology? Do you use a tool like Chronograph or something like that?
Yeah, so it really is company specific, John. And it's some companies, they'll have visibility for 6, 12, 18 months, just depending on the nature of their customer procurement process and their purchasing cadence. Some businesses, we have 2 weeks of visibility. If it's a quick turn operation, if it's a shorter production cycle, if customers need their product now, and that can be, that's contingent on markets, it's contingent on business models. So it's hard to say across the portfolio, kind of a silver bullet approach. For a lot of our companies, and we can talk about this in great detail, but sometimes it's roughly 50% of the companies we're investing in, we're buying and investing with entrepreneur owners or founder owners, and sometimes the systems they have in place are a little bit lacking in terms of forward visibility, right? This is, core to and something close to your heart and Blue Margin's heart. And so, that's part of the thesis, and what we want to help those teams do is, give them more visibility in the windshield rather than in the rearview mirror, right? We want to help them with preparing for what's coming rather than, reporting the news, so to speak.
It makes me think of the difference between PE firms and sort of the personality or approach in working with management teams. Some really hold to a hands-off, get the right team in place and give them the latitude to execute. Some are more involved as operating partners, even across, every partner plays sort of an operating role. How deeply are you entrenched in the various companies? Generally, I know it's going to vary from one to the next, but what's your philosophy there?
Yeah, our general approach is we want to provide the resources, the tools, our experience set, but provide them at the management team's election to use, right? We don't really force things down our management team's throat. We ultimately are trying to get the right team on the bus, get alignment on the strategy on where we want to take the business, and then leverage that 2.5 decades of experience, resources, advisors, et cetera, and say, hey, here's what you can use, right? And let's figure out together what are the right tools and solutions for that specific company, rather than say, here's our monthly package. You have to fill this out. Here's our tracker. Make sure you fill it out so we can aggregate it and do it. Because ultimately, we feel like that's just wasting the management team time if that's not how they view the business. And ultimately, we want them creating value, developing strategies, executing on those strategies, developing customer relationships, working on operational excellence, et cetera. We don't want them spending time filling out trackers or building dashboards for the private equity firm. We don't find that as a constructive use of time.
But fiduciarily and otherwise, you want to be in sync and know that they're tracking to the VCP. Do you generally have a good feel for that? Is there a process for that? Is it just the monthly board meeting? How do you maintain that?
Yeah, so we do have kind of set meetings or calls on a monthly basis, and then more formal on a quarterly basis, a formal board meeting. But even formal can be different on a case-by-case basis, right? Depending on where we are in the hole, depending on the team is executing, it could be a day or two on site. It could be 2 or 3 hours over Zoom. But in addition to that, John, I think we try to set up a framework of transparency and constant communication. We don't want to be showing up at the facility and running the business. That is not our goal, nor would that be good for anybody. But we want to be hearing about good news and bad news all the time, right? And it could be a text message, it could be a quick email. We don't want, hey, we're waiting until the 15th of the month to review the prior month's financial package to be this great surprise of, hey, how did we do last month? We want to know during the month, hey, bookings are coming in a little bit light. What are how would you guys, what do you recommend? Or, here's what we're thinking about doing. And you'd be a thought partner, right? And we want to hear about the bad news as much or more than the good news. Good news is great, but we want to be part of the solution to help solve, or at least a thought partner to bounce ideas off, particularly on the challenging multivariable equations or problems.
Yeah. It's easy as a management team, having been on a few, to see bad news as bad, as opposed to here's another data point we need to address, and to sort of keep it at bay. That can be problematic. And I'm sure it's on a sliding scale. This might be Captain Obvious, but as things are not going well, I assume your scrutiny increases. As things are going well, you can back up more. Is that accurate, or am I overstating?
Yeah, I think that at a high level, that is right, John. But I think you also need to just so you can put some definitional framework around, well, what is good and what is bad, right? You can have businesses that, we've had businesses, particularly because we focus in the industrial sector, that have a little bit more cyclicality in their demand, and you can have years where activity levels are contracting fairly significantly relative to other industries. But so you might look at the financial package and say, oh, things aren't going that well. But this is goes to the data and what are the key metrics and the KPIs you need to be tracking that say, hey, revenue might be down 20%, but the team is really kicking butt and doing great. They're taking share. They're finding ways to accelerate growth opportunities, expand their addressable market, launch new products, et cetera. So I think at a high level, when things aren't going right, you're right. We do lean in a little bit more, but I think it also requires a little bit of framework and what lens you're looking through to determine, to make that determination.
Yeah. Okay. Getting a little more towards the ground. You could argue that the goal is to close the gap between the value creation plan and the execution of it. It's always a challenge. That's sort of the ongoing game that you play. Uh, to affect that, to make that happen consistently, do you have a very strong first 100-day, not formula, but approach to make sure that everyone's looking at the most important KPIs that map to that VCP? Do you try to get that in early? Do you have a methodology for that?
We do, yeah. So we do incorporate the 100-day plan, which within that incorporates strategic planning, which I think is where you're kind of going, and we'll hit on that. But also a lot of the findings from diligence, and some of that could just be operational hygiene or things that you found during diligence, and making sure you're cleaning those up. But then, yeah, we early in the hold period, sometimes even before close, we're working with our management teams to determine that strategic plan. Sometimes we'll bring in an outside facilitator, a third party, where we may not even be present. We want to get the team to really come together, buy in, and say, this is our roadmap. We can then be a thought partner to pressure test, provide insight to make sure that when you get to the end of that journey, it's a destination that we all want to be at. But then ultimately, that is the roadmap that we are reviewing on a monthly and quarterly basis, making sure that we're hitting the metrics necessary so that we don't get to that end of that journey and we're not where we want to be, right? Yeah. And we also have those guardrails in place to continue to assess performance and make sure that we're all moving in the right direction and course correct, right? If things aren't going well, maybe there's a change in the strategy or an opportunity's come up and we need to divert historical resources that we thought would be, for one of the, for one avenue of growth that we need to allocate somewhere else.
Yeah, makes sense. So you have a background in investment banking and acquisition diligence. When you evaluate a company, an investment opportunity, how does a company's handle on their data, how well they know their numbers, what level of mastery they have over their sales, finance, operation metrics, et cetera, how much does that influence their attractiveness or valuation when you're looking at an investment?
Yeah. So, John, I think it's both an opportunity and a risk. As I mentioned before, 50% of our businesses are typically we're not investing in them, acquiring them from a different private equity firm or other form of institutional capital. And even if they are backed by other institutional capital providers, it doesn't necessarily translate to the greatest data management, et cetera. But I provide that background of sometimes you have real very homegrown teams that have been focused on their customers, focused on growing their business, focused on putting out fires day to day. And they've grown their business from, X million of revenue to Y million, and they're doing an excellent job executing. But then when it comes to them telling a story, they may not even appreciate what they have, right? They may not even know particularly if you have hundreds of customers there or hundreds of thousands of SKUs. You can ultimately, when you start analyzing those businesses, there can be some really interesting golden nuggets in that data that an entrepreneur may not even appreciate. So there can be some opportunities when we're looking at those companies that ultimately we find more value than maybe what's even communicated to us. On the flip side, that also can be a risk. If there isn't great control of their data, their systems, their processes, the key metrics that folks are, at least the management team, the operations, really throughout the entire organization are all focused on, that can create some risk as to operational hygiene, we call it here. But are there things in the operations that maybe make them exposed from a competitive standpoint that their competitors are doing that they are not, that ultimately questions the longevity of that specific company?
Yeah. I had a short stint as a house flipper back when everyone was a house flipper and thought they invented it. And one of the objectives or strategies there was to be able to see past the mess and the holes in the drywall and see the vision beyond it. Do you look for companies that could benefit greatly from shoring up their operations, their IT systems, et cetera? There's potential there. There are diamonds in the rough. Is that part of the formula, or does that not come in as a sort of preset element that you're looking for?
Absolutely, it's part of the formula, if you will, John. I think it's thinking about, as you framed it well with kind of house flipping, what systems and capabilities do they have today, and what do we want it to look like going forward? I think for two reasons. One, just managing the business, giving that insight, giving it in real time. And I'll give you an example. We invested in a company once where they really had no interim financials throughout the entire year, something that most of us would think of as unusual, right? But they'd really just consolidate at the end of the year. They'd look back, hey, was it a good year or a bad year? And they pay profit sharing based off of that. And it was a management team that had been in the industry for 30 years, so they kind of had a smell to, well, are we busy? Are we not? Is the shop floor active? Are people, they got a pep in their step? So they kind of feel it, but then you just start to do doing something fairly basic of, we're just going to give let's create a monthly reporting package that includes some basic financial metrics. And all of a sudden, 3 months into a fiscal year, you realize, hey, we're a little bit off target, or we're behind at least previous year. We should be ahead. What's going on? So you're making a decision at day 90 versus maybe in the prior to that change, you're making it at day 366. So very simplistic example, but so from a standpoint of increasing the data and the financial tracking, it makes it easier for the management teams to run the business on a day-to-day basis. But also when we look to exit our businesses and investments, being able to point to some of those trends that maybe we identified during diligence, and being able to have that being properly tracked if it's an important metric, and also being able to kind of validate that growth story, or properly communicate with data the forecast and what the company has on the horizon, that typically is going to get a buyer much more comfortable of, hey, I'm going to buy this company or make an investment in this company, and 5 to 10 years from now, here's where it's going. Here's my 5-year forecast, and have a lot more comfort in it based on whether it's bookings trends or platform visibility. If it's an automotive, aerospace and defense, commercial vehicle supplier, you can get a lot of granularity and a lot of defensibility in the forecast, which ultimately, when you go to sell the business and liquidate your investment, realize your investment, you typically get a higher purchase price for that visibility and that comfort you're providing to the buyer.
Yeah. So speaking of data, do you think about as an objective to get your portfolio companies to data driven, which I realize is a subjective term, and define it how you like, maybe for your answer. But is that something you guys think about and work on?
Definitely. Yeah. It's something we're focused on, and it ranges company to company so much, where I think of data or being data driven, it's kind of it's a journey, right? It's an evolution. And for some companies, they maybe already have, Power BI, Tableau, they're running Power Pivots. They know all the analysis, and they're looking at that on a daily, weekly, monthly basis. Some companies, as I highlighted, it may be giving a monthly reporting packages. And for them, that's being data driven, or creating a weekly tracker, or a weekly snapshot of just bookings, shipments, and cash. Something as small as that, a very basic scoreboard, and compare it to prior week, or compare it to prior year, compare it to a budget, whatever works for that team. And the key is to get companies to look at those metrics and actually start to agree that they're important, and to start to kind of quote unquote buy in, right? That they start looking at that scoreboard, and it's great as a partner and as a sponsor to suggest something, recommend something, they agree to it. They do A, B, and C because that's what you said. Hey, just think about that. And then they come back a month later and say, hey, everyone's looking at this. We should do D, E, and F. Because ultimately, these management teams know their companies better than we'll ever know it. So it's really just being that thought partner and putting that scoreboard up. So then people are really, they're focused on it, and they're excited about it, and they're using that to drive the business.
For thought partner, do you also think accountability partner? Not in the negative sense of I'm going to, hold your feet to the fire, but for all of us, having someone outside look at what we're thinking about and doing adds perspective and gets you outside of your bubble. Do you think in terms of accountability?
Oh, all the time. Absolutely. As you mentioned, fiduciary responsibility, but also, setting that accountability, whether it's a strategic plan, an annual budget, a quarterly expectation, specific initiatives. Here's the capital we're going to invest. Here's the payback we're going to realize, and here's when we're going to realize it. We're always, keeping, we're always using that as a reference point, right? To determine, we all want to hold everyone accountable. We expect our teams to hold themselves accountable. As a board, we hold ourselves accountable for signing off on investments or signing off on initiatives, and ultimately, we're held accountable by our partners at IGP and our broader limited partners, our investors as well. So I totally agree.
Yeah, at Blue Margin, we do dashboards and data warehouses, and we're always careful to not put form over function. We maintain that if you can achieve the goal with a clipboard and a pen, great, do that. The goal being things like accountability, a sense of team around a central playbook, giving people agency and ownership over their area of the business. And what BI does for you is it puts it in a central location, makes it automated. Really, you're trying to surface for top of mind awareness those metrics that define success according to the thesis or the value creation plan. Are you trending towards more BI and dashboards, or is it highly variable? Sometimes it's just Excel, sometimes it's a clipboard. Well, it's probably never a clipboard, but do you have a trend in that direction in terms of BI? And don't answer for my sake.
Yeah. I mean, it's a little alley-oop, right? So it definitely is trending more towards BI, but you have to look at it again by company and where they are in their data journey, and also by functional areas. So some of our most effective investments, some of our best run companies, they love having big whiteboards throughout the facility, showing capacity planning, showing when jobs are due, showing their key metrics, because people are generally visual people, and that doesn't necessarily mean to be it's a super sexy dashboard that's cloud based, right? It could be literally a whiteboard on two legs in the middle of a manufacturing facility, and that may drive the outcome that is necessary for that specific situation. But overall, it's generally a trend towards electronic forms as real time as you can make it. But as long as you can see it, as long as it's easy to understand, and those are the key things for us. And ultimately, making sure people it drives behavior, right? Yeah. And I think you can get the inverse if you try to push too much data or too many metrics and no one's looking at it. It actually creates, I think, a little bit of a whiplash the opposite way of, well, people are just tracking things to track them. We're hiring people just to run analytics that no one's driving behavior. So it's finding that balance. And I personally think it's better to just start with a couple, 2 or 3 metrics that are easy to see, and then expand from there, rather than saying, all right, here's our 50 KPIs. Well, it's hard to generate action from that.
I think a lot of companies stumble there. I mean, ultimately, you're trying to focus on the outcomes of the business. That's really what you're after. And there's that story of the industrial magnate who writes on the shop floor in chalk, here's how many skeins or whatever of steel the previous shift put together. And the new shift walks in and says, what's that? Well, that's 4. That's what the last shift did. All right, we're doing 5. I mean, that's enough. And a whiteboard has a certain tactile value that people can attach to. And sometimes that is not scalable, and you got to go to something else, dashboards and so on. Back to data-driven, what role does that play in being able to paint a picture for the next owner, the buyer, whether that's a strategic or another investor, in being able to tell the story of the future growth and increased value of the company? Is that a big deal? I know there's always the data room at that point of liquidity, and data rooms can be messy. Do you make it a goal to be able to present more coherent and sort of narrative pictures of the data and where the company's headed? Is that something you guys think about?
We do. Yeah, it's a great question. And you think of, for some of our industries, when they may have visibility from their customers if they're being spec'd into a specific OEM platform. Again, aerospace and defense, automotive, commercial vehicle. It ranges across a number of industrial end markets. But every buyer is always skeptical of the future, right? They always want to say, there's always an element of, hey, prove it to me. And how much the amount of granularity and specificity that you can point to as a seller is going to increase the ability or the confidence that a buyer has in underwriting that forecast, right? And sometimes you see companies that say, hey, we grew 10% the last 3 years. We're going to do that for the next 6 years. So that's what we should do. Well, that doesn't give you quite the comfort of saying, hey, here's our exact customers, our exact platforms that we've been tracking historically. Here was our forecast 5 years ago, and we were spot on based on production builds. Here were the platforms we were on. We're doing the exact same thing for the next 5 years. So Mr. Buyer, you should pay us for our entire forecast. You shouldn't be haircutting it or discounting it or risk adjusting it. It's a lock. So if you can create those systems and develop those systems, it's difficult to do in a short time period, right? But you got to start small, and ultimately, if you can create that level of visibility, it usually you're rewarded handsomely when it ultimately comes to exit to give that buyer that confidence in your forecast.
Yeah, we see one of the primary issues or the primary issue in managing a company or overseeing a company from the board is just plain visibility. Can everyone see what's happening? Is there a scoreboard like at a baseball or football game that everyone could see that has the salient info? If you can get to that, you're sort of 80% there. Is that overstating it for you?
I think that's right. And I think it's particularly, again, for the industrial space where, some of these markets I've highlighted, they can have 10 or 20% increases or decreases in production, at least overall market activity in any given year. So again, if a company may be down 10%, but if their market's down 20%, they may be really doing a great job, just given, an anomaly or 1 year of decreased demand, and having the metrics, maybe it's new customer acquisitions, or it's revenue from new customers, or scope increases, cross-selling, revenue from new customers in existing geographies. All those types of metrics can give you confidence as a board, but also as a management team of, hey, you can't just look at comparison versus prior year. You got to look at these other metrics, which are more indicative of the vitality of the business on a go-forward basis.
Yeah, a more accurate picture, not getting myopic on certain metrics that are sort of classic, but may not tell the story.
Yep.
One more question and then some closing thoughts. There's a growing trend in private debt fundraising, particularly through direct lending. PitchBook just reported in their Q3 US PE breakdown that take private surpassed $100 billion for the second consecutive year. Private debt funds are stepping in for banks to provide that financing. Can you tell us more about this trend and what our audience, mid-market execs and PE professionals, should have in mind for how this impacts them?
Sure. So really the direct lending phenomenon came out of or as a byproduct of some of the regulatory changes from the Great Recession. So following that, additional regulations were imposed on commercial banks who were one of the primary lenders for our market in terms of the leveraged buyout market. And so there was this void, and that void was filled by direct lending pools of capital. And they are, as you mentioned through the stats, there has been a growing trend from that kind of piece of the market and that capital availability. What that means for middle market execs and PE professionals, I'd say, is it's similar to equity, whether it's growth equity or control positions, buyout funds. There's similar a wide range of capital availability on the debt side. So there's commercial banks, BDCs, there's direct, as you mentioned, kind of the direct lending vehicles, and each of those there's pros and cons in terms of costs, restrictions on the company, reporting requirements, et cetera. But I think it's just relevant that there's a wide range of debt capital available as well, which is in general, a trend. If you're a middle market executive or an owner of a company, more capital flowing into your space is generally a good thing. But it's not only on the equity side; it's also on the debt side.
Yeah. Where do you see the PE industry going? There's increasingly more funds out there competing for deals. It's been an incredible ride to date. Do you see that continuing into the foreseeable future?
I think it will continue. I think the degree of difficulty continues to go up as more capital is flowing into our space, into the broadly private equity industry. Valuations continue to go up, which it just makes the degree of difficulty a little bit higher, which we think it kind of goes back, going full circle in our discussion. It's advantageous for the firms that really specialize in where they're good at, where they have angles industries they have experience in, and that they can really assist their portfolio companies to do things. It's no longer in the days of we're buying a company for an X times multiple and just putting it on the shelf, and we'll look to dust it off and sell it in 5 years, and we'll create returns that are satisfactory to our LPs. Those days are pretty much gone. Now it's what can we do with this management team? What can we do with this company? Whether it's some of the add-on things you highlighted earlier, add-on acquisitions, go-to-market investments, operational excellence, data-driven mentality. Can we do those things to take a company that's a really good company and make it a great company?
Yeah, that says a lot for the PE industry coming from a perspective of the principles of free enterprise, and that increasing difficulty requires better management, better companies, more value to the market. I'll make sure to send a copy of this to the regulators, keep them on track with the good things you're doing. Yep. Final thing here, leaders are readers. So we hear. Any favorite books, luminaries, et cetera, that keep you at the forefront of the PE industry, folks that you like to follow that you think are really wise in this space?
Yeah, in terms of books, it's a good question, John. It's interesting. Like as I've developed in my career, like the types of materials that I read have changed, right? So when I was more junior associate, I was still reading security analysis, valuation, kind of your classic core kind of finance technical books that you dust off from maybe your university days. But as I've progressed, a lot of our job now is really focused on people and relationship buildings of teams, organizations. So Culture Code and 5 Dysfunctions of a Team are books that I've read that have been very helpful as we're thinking about management teams, board construction, and then just internally how we're organized and developing a team that ultimately is best positioned to win in a very difficult market.
Yeah, and how to win friends and influence people. That's an important one.
No, that's another good one too. It's a really good one. Yeah.
So what's next on the horizon for you?
Well, we just raised our 6th fund at IGP, a $1.2 billion pool of capital. So we're going to be pretty busy over the next 2 to 4 years looking to deploy that fund. So find some great companies to make investments in. Really excited to partner with those management teams. And then, that's kind of the primary focus at IGP.
Any hint on sectors that you're going to more emphasize with that new fund? Is it aerospace?
Yeah, I'd say it's a little bit more of the same. We have some industries that we really like: aerospace and defense, commercial vehicle, automotive, utility services, infrastructure services, packaging, food and beverage. So really anything that's manufacturing, industrial services, we get excited about. A lot of people don't get excited, but the hair on our arms sticks up when we find good companies in those spaces.
Yeah, same here. That's our wheelhouse. We love that stuff. For those who want to speak with you further, what's the best way to get in touch?
Yes, our website is igpequity.com. Our emails are on the website. Mine is jgp@igpequity.com. We'd love to hear from anyone who's evaluating private equity, considering it. Even if we're not the right partner, we'd love just to talk to as many people in the space as possible, not only prospective companies that are looking for institutional capital, but also people who are interested in the space professionally, people who are advisors, executives who have maybe haven't experienced private equity historically and are interested in it, or maybe they're a seasoned private equity professional and they're looking to get some different perspectives. We welcome all correspondence and would love to just continue to expand the network.
Yeah, I'll add to that. We've worked with a lot of PE firms, and IGP is among the good people for sure. So I would encourage that as well. Thanks again for your time, John.
Yeah, thanks, John. Great chatting with you.